Welcome to the deep dive. Today we are looking at a stack of incredibly alarming economic reports from March 2026.
Yeah, alarming is definitely the right word for it.
Right. And our mission for this deep dive is to cut through all the noise and look at the very real forces directly threatening your investment portfolio, the prices you're paying for groceries, and
And your job.
exactly, your actual job security. With this bizarre new twist involving artificial intelligence that we are definitely going to explore, because right now the U.S. economy is like a car flying down the highway where the dashboard has just suddenly lit up red.
It's terrifying when that happens.
Oh, totally. You look down, you don't just see one warning light. You see the check engine light, the oil pressure warning, and the battery alert all glaring at you simultaneously.
And your first instinct in that scenario is to, pray for a sensor glitch. Because if all three of those major systems are failing at the exact same moment, you are looking at a catastrophic failure.
A complete breakdown.
Right. And when we look at the macroeconomic dashboard today, those three red lights represent a very specific, terrifying economic buzzword straight out of the 1970s, stagflation.
Stagflation.
Yeah, it is the monster under the bed for analysts and investors alike right now.
Okay, let's unpack this. Before we get into the scary new 2026 data drops, we need to clearly define the monster we're dealing with here.
For sure.
So stagflation is this three-pronged beast. You have elevated inflation, you have rising unemployment, and you have incredibly low economic growth.
All hitting at once.
Right. Going back to our car metaphor, normal economic problems are usually one-directional. But stagflation is like trying to drive with the parking brake fully engaged.
Which is the low growth and job losses.
Exactly. It's dragging your momentum to a halt.
Yeah.
But while that's happening, your engine is completely redlining and overheating, representing the high inflation. You're stuck, but you are burning up.
What's fascinating here is why this specific combination is so uniquely toxic compared to a standard recession.
Because it's a completely different animal.
It really is. In a typical recession, the mechanism is fairly straightforward. Growth slows down, and unfortunately, companies lay people off.
Which is awful for the workers.
Right, incredibly painful. But it triggers this self-correcting economic mechanism. Because people have less money in their pockets, overall consumer demand drops.
People stop buying stuff.
Exactly. When demand drops, businesses are forced to lower their prices to attract whatever few buyers are left. So inflation naturally cools off. The disease essentially cures itself.
But in stagflation, that self-correcting mechanism just completely snaps.
It shatters. People are losing their jobs, the economy is stalling out, but the cost of living relentlessly climbs anyway.
The grocery bill goes up even though the paycheck disappears.
Yeah, you are getting squeezed from both ends simultaneously, which is exactly why it leaves such deep psychological scars on consumers and policymakers.
And we aren't just theorizing about historical ghosts today either. The sources we're analyzing prove these fears are showing up in the present-day data.
The dashboard is definitely flashing.
It is. Let's look at the growth prong first. The U.S. Commerce Department recently revised down the fourth quarter GDP. The initial estimate was already a fairly modest 1.4% growth, but the revision, it came in at a sluggish 0.7%.
Wow, that is a severe deceleration. I mean, an economy growing at 0.7% is essentially a bicycle moving so slowly it's starting to wobble.
At the dip over.
Right, we are scraping along the bottom, highly vulnerable to any external shock that could push us into negative territory.
Which brings a lot of anxiety to the labor market. The latest BLS jobs report showed that analysts were expecting the economy to add about 50,000 jobs.
Which is already pretty low.
Right, but the actual number, the economy lost 92,000 jobs.
Ouch.
Yeah, that is a nearly 150,000 job swing from expectations in the absolute worst direction. It definitively checks the rising unemployment box of our stagflation definition.
It is a massive miss, and usually a labor market contraction of that size would immediately trigger that self-correcting mechanism we just talked about.
Demand should be falling.
Yeah, demand should be falling, and prices should be dropping.
You would think a slowing economy and vanishing jobs would at least mean cheaper prices at the register. But the Fed's preferred inflation metric is showing the exact opposite.
Which is the terrifying part.
Now, hold on. Let me interrupt this doom and gloom narrative for a second.
Yeah.
Because I'm looking at the headline PCE number from the source material here, and it came in at 2.8% year over year.
Right.
And the sources explicitly note that this actually slightly beat expectations. If headline inflation is beating expectations, why are the markets panicking? Shouldn't we take a victory lap?
Well, if you only look at the surface level headline number, you might be tempted to. But to truly understand the inflation picture, the actual pulse of the economy, we have to strip away the noise and look at the core PCE numbers.
Meaning we strip out the costs of food and energy.
Precisely. Food and energy prices are highly volatile. I mean, a drought in the Midwest or a sudden geopolitical conflict halfway across the world can cause those prices to wildly spike or crash from month to month.
They just bounce around too much.
Exactly. They obscure the actual foundational trend of prices in the broader economy. Core PCE removes those volatile elements to show us the sticky underlying inflation.
And what did that come in at?
That core PCE came in at 3.1% year over year, rising 0.4% just for the month. Both of those figures missed expectations and came in hot.
So it's not cooling down at all.
Not at all. It proves the underlying inflation is stubbornly glued in place, well above the Federal Reserve's target rate of 2%. The engine is absolutely still overheating.
So the trilemma is verified by the data. GDP is barely registering at 0.7%. The BLS reports 92,000 jobs lost, and core inflation is stuck at 3.1%.
The parking brake is engaged and the engine is smoking.
Here's where it gets really interesting, because if we look deeper at that massive job loss number, the sources point to a highly unusual factor driving this unemployment spike.
Something completely unprecedented.
Right, something that definitively was not around during the 1970s stagflation crisis. Artificial intelligence.
Ah, the AI wild card. It completely warps the traditional economic models we use to understand labor dynamics and capital allocation.
It's crazy. Our sources present this dizzying paradox. On one hand, you have major companies explicitly citing AI disruption and automation as the direct primary cause for their recent rounds of layoffs.
They're being very open about it.
Exactly. They aren't handing out pink slips because consumer demand is plummeting or because their balance sheets are failing. They're laying people off because an algorithm can now accomplish the exact same task in a fraction of the time.
It's efficiency at a brutal human cost.
But simultaneously, AI is acting as an unprecedented wealth generator for investors.
The scale of the wealth creation being projected in these reports is, it's almost difficult to conceptualize.
Let's put a number on it. The source material highlights projections from major institutional investors like Cathie Wood, stating that AI is on track to become an $80 trillion opportunity by the year 2030.
80 trillion.
80 trillion. To put that into perspective, the report notes that is the equivalent of 18 NVIDIAs, 21 Microsofts, or 33 Amazons.
That is staggering.
But what completely blew my mind in these reports is the structure of this massive wealth generation. The sources detail how almost all of this unprecedented growth has to squeeze through a single technological choke point. They describe a little-known company as an indispensable monopoly.
This is a crucial piece of the puzzle. When we talk about an $80 trillion boom, we often imagine a vast, decentralized wave of innovation lifting thousands of boats.
Like the early internet days.
Right. But the physical reality of artificial intelligence requires highly specific, incredibly complex silicon chips. And the capacity to manufacture the machines that actually print those microscopic cutting-edge chips is essentially controlled by a single monopoly.
Giants like NVIDIA, AMD, and Intel, the companies actually designing the AI brains, literally cannot function without the technology provided by this one choke point.
They are completely dependent on it.
They are the toll booth on the highway to the AI revolution. If you want to build a data center capable of training a next-generation language model, your capital eventually has to flow through this specific monopoly.
Which represents a profound structural shift in the global economy. And if we connect this to the bigger picture, this technological boom severely complicates our understanding of stagflation.
How so?
Well, historically, when unemployment spiked during a stagflationary period, it was a symptom of broad systemic economic weakness. Capital was drying up. Nobody had any money to invest.
Right, the whole system was just starved.
But today, the job destruction is happening concurrently with historic, record-breaking capital formation.
The money is definitely still there.
It is absolutely there, but it is being aggressively reallocated. It is being moved away from human labor, middle management, copywriters, analysts, and channeled directly into silicon, into automation, and into these indispensable tech monopolies.
So if you are the everyday worker, you're looking at an economy that is simultaneously minting $80 trillion opportunities while handing you a pink slip.
It's a completely different flavor of job loss.
Which naturally leads us to the big question. With inflation remaining sticky, GDP grinding to a halt, and AI fundamentally rewriting the labor market, How do the people in charge actually fix this?
They are effectively trapped. You're looking at the Federal Reserve trying to walk an impossible tightrope.
Let's break down the mechanics of the Fed's dilemma. By law, they operate under a dual mandate from Congress.
Right, they have two main jobs.
They are tasked with ensuring stable consumer prices, which generally means keeping inflation hovering right around 2% and ensuring maximum employment for the American worker.
Which is usually fine. In a normal economic climate, they use monetary policy to balance the scales.
The primary tool in their monetary policy toolkit is the federal funds rate, right?
Exactly. By raising or lowering this interest rate, they influence the cost of borrowing across the entire economy. If the Fed wants to fight inflation, they raise rates. This makes it more expensive for banks to borrow money, and the banks pass that cost on to businesses and consumers.
Right, so a small business looking to take out a loan to build a new warehouse suddenly faces a 7% interest rate instead of a 3% rate.
So they scrap the expansion plans.
They don't hire the 50 new workers they were planning to hire. The economy cools down.
Exactly. But what happens when you apply that mechanism to an economy that is already losing 92,000 jobs a month and barely growing at 0.7%?
You completely crush it. Let's use a new analogy here. The Fed is basically playing a brutal game of economic whack-a-mole.
That is a very accurate way to look at it.
Right. If they hit the inflation mole by raising interest rates, the unemployment mole pops up and grows twice as big, crushing the job market. But if they try to hit the unemployment mole by lowering interest rates to stimulate the economy, the inflation mole explodes because they just poured gasoline on the fire.
It is a devastating trade-off. Using monetary policy to fix one side of the stagflation mandate actively mathematically worsens the other side.
They can't win.
They really can't. The market recognizes that the Fed is cornered. That is exactly why our sources highlight that Wall Street strategists are deeply spooked right now. They are rapidly throwing out their previous forecasts.
Right. The predictions are changing fast.
Very fast. Many are lowering their expectations for interest rate cuts this year, and some strategists are now predicting there will be 0 rate cuts in all of 2026.
0 cuts. Which translates directly to everyday life. Expensive mortgages, high credit card APRs, and costly auto loans are here to stay for the foreseeable future, all while companies are laying people off to pay for AI servers.
It's a grim picture.
I realize that everything we have unpacked so far sounds terrifying. But the primary thesis of the source material we are diving into today is actually that you, the investor, should not panic.
Which sounds totally counterintuitive given the dashboard we just described.
It really does.
But when you look under the hood of these reports, there is a distinct undercurrent of optimism. You just have to understand the nuances of the data.
Okay, let's pivot and break down the 4 specific silver linings outlined in our sources.
Yeah.
The first reason to take a breath is simply about market expectations.
Right, what Wall Street already knew.
The sources point out that Wall Street already expected inflation to bump up in early 2026, peak, and then gradually fall back below 3% toward the tail end of the year. So this recent sticky inflation data isn't a total shock to the system.
It was already baked into the pricing models.
Exactly.
Financial markets despise surprises far more than they despise bad news. Because this bump was largely anticipated by institutional investors, it acts as a buffer against a panicked, broad market sell-off.
That makes sense.
But the second reason for optimism is perhaps the most fascinating piece of this puzzle, because it involves a literal glitch in how the government data was recorded.
Yes, the data glitch. This provides massive context. Our sources point out an interesting quirk regarding a government shutdown that happened back in October and November of last year.
Oh, this is wild.
According to the analyses we're reading, because of that shutdown, the Bureau of Labor Statistics couldn't collect their regular real-time data for the inflation reports during those 2 months.
They literally couldn't do their jobs.
Right. So the sources argue that the BLS simply assumed 0 price growth for that missing period.
Think about the mathematical implications of that. Prices in the real world almost certainly continued to grow during October and November.
Of course they did.
But by officially recording 0 growth on the ledger back then, the baseline was artificially lowered.
Let's walk through the math on that for the listener. If a gallon of milk was actually going up in price, but the official spreadsheet said it stayed exactly the same for 2 months, last year's average looks incredibly low.
Right.
So when we calculate year-over-year inflation today, we are comparing today's real higher prices against last year's artificially low, glitchy baseline.
Precisely. It mathematically exaggerates the current jump. It creates a statistical illusion where the inflation spike looks significantly more drastic on paper than the reality consumers are actually experiencing on the ground.
It's a phantom spike caused by a paperwork gap.
Exactly.
Okay, the third reason not to panic brings us to global geopolitics. Specifically, the ongoing conflict involving Iran and its impact on the price of oil. We know that surging oil prices resulting from this conflict are going to spike the upcoming March PCE numbers.
The sources are very transparent about that impending hit.
But they also offer a silver lining regarding the timeline.
Yeah, the silver lining lies in the historical behavior of commodity markets. Geopolitical spikes in oil are frequently sharp, violent, but ultimately short-lived.
They don't last forever.
Right. If the conflict resolves quickly or if supply chains reroute efficiently, oil prices could plummet just as fast as they rose. Furthermore, the underlying economic foundation supports a rapid drop.
Why is that?
Our sources note that before this conflict even dominated the headlines, most market analysts already held a very weak bearish outlook for oil prices in 2026. The fundamental organic demand for oil wasn't driving the price up. Pure geopolitical fear was.
So once you remove the fear from the equation, the price collapses, taking a huge chunk of that headline inflation down with it.
Exactly.
Which brings us to the fourth, and honestly the most counterintuitive reason for optimism found in the stack. The idea that a slower economy is actually the exact cure we need.
This is the big one.
The sources suggest that the dropping GDP and the rising unemployment, the exact things causing everyone so much anxiety right now, might actually force the Fed's hand by naturally squashing consumer demand and stabilizing prices.
Yeah.
Let me ask you this directly. Are the sources actually arguing that bad news for the everyday economy is the medicine required to cure inflation?
If we connect this to the bigger picture,
Yes.
they are describing a harsh but natural economic reality known as demand destruction.
Demand destruction.
Yeah. When people lose their jobs or even just begin to fear losing their jobs to AI automation, their behavior changes instantly. They stop buying new cars, they cancel vacations, they stop eating out.
The spending just stops.
When GDP slows to a crawl, businesses halt their expansions and stop aggressively raising their prices because consumers simply won't pay them anymore.
So the economic pain effectively does the Federal Reserve's job for them.
It does. A mild, controlled recession naturally starves inflation of the fuel it needs to survive. Once that demand destruction successfully stabilizes the prices, the Federal Reserve is suddenly freed from their impossible tightrope.
The fever has broken.
Right. The Fed can then safely step in, lower interest rates, and stimulate the economy to rescue the job market without the paralyzing fear of reigniting inflation.
So the disease cures itself, but the patient has to suffer the fever first.
It is undeniably painful in the short term, but it is a natural self-correction mechanism that clears the brush and paves the way for long-term economic health.
So what does this all mean? Let's synthesize the journey we've been on today. If you are looking at the economic dashboard right now, yes, you are seeing classic stagflation warning signs.
The lights are flashing.
We have sticky core inflation refusing to budge from 3.1%. We have a dropping GDP of 0.7%. And we have sudden, severe job losses that are being fueled by this massive transition toward artificial intelligence.
That's a lot to take in.
But the underlying context is everything. The analyses we've reviewed show that temporary data glitches from government shutdowns, baked-in seasonal expectations, and volatile geopolitical variables in the oil market strongly suggest that the sky isn't falling just yet.
Far from it.
Furthermore, the very economic slowdown we are experiencing might be the exact mechanism that destroys inflation and eventually allows the Fed to lower rates.
The overarching takeaway from all of these combined reports is clear. Long-term investors must resist the urge to react emotionally to these short-term macroeconomic shocks. Panic, especially at this stage, is entirely premature.
It all comes down to keeping your hands steady on the wheel, even when the dashboard is aggressively flashing red.
But before we wrap up this deep dive, we have to address the elephant in the room, the AI paradox we discussed earlier.
This raises an important question. And it's something I want you, the listener, to really mull over as you watch the markets this week.
Let's hear it.
If artificial intelligence is truly on track to become an $80 trillion wealth generator, heavily concentrated through indispensable tech monopolies, while simultaneously driving the job losses that are actively contributing to this stagflation scare, are we entering a totally new paradigm?
A completely different system.
Right. An era where the massive historic success of the stock market is permanently divorced from the economic health and stability of the average worker. Wow. It is a chilling thought to leave on. Because if the stock market continues soaring on the back of unprecedented AI efficiency, but the everyday person is left struggling with sticky inflation and a vanishing job market, well, it might just mean that the warning lights on our dashboard aren't broken at all. They might be working perfectly, telling us that we are driving an entirely different kind of machine now.